Welcome back, everybody. Nvidia has reported earnings, which means we all have the totally rational and completely calm and logical takes about what it means for the markets and Nvidia investors. Okay, maybe not completely rational and calm, but you know what I mean. Also, Lululemon reported earnings and finally gave us a glimpse into how they've actually been performing versus all the negative market sentiment that's been out there about the company. And lastly, and maybe most importantly, I decided to add something new to my portfolio yesterday, and it's going to make all of the hardcore value investors cringe since it's selling at a whopping 90 price to cash flow. So let's get started. Okay, now first up is Nvidia, and here's what I said I was looking for from them in their earnings call. Now, Nvidia's earnings are still about 6 weeks away, but again, it's a simple question of if the growth story is still intact. Everyone out there is saying it's going to slow down, it's time to get bearish, and personally, I just don't see it happening yet. So this quarter will again be about whether or not their growth rate continues to exceed market expectations, and we'll just have to see. So now, if we take a look at what their outlook was from the previous quarter, this is the guidance that they gave. Revenue was expected to be $28 billion, plus or minus 2%, and then GAAP and non-GAAP gross margins were expected to be 74.8% and 75.5% respectively, with operating expenses being approximately $4 billion and $2.8 billion from a GAAP and non-GAAP perspective. So that was their outlook. Let's take a look at what they actually reported. Nvidia had revenue of $30 billion, so they definitely beat over the $28 billion that they had as their guidance. Their gross margin from a GAAP perspective was 75.1, and from a non-GAAP perspective, it was 75.7. So again, they beat on that. And then operating expenses were 3.9, which is under the 4 that they guided for GAAP expenses, and then 2.79, which was also under the 2.8 that they guided for non-GAAP expenses. And so in general, they beat expectations, or at least their own guidance that they gave, in pretty much all measures. And if we take a look at analyst guidance, we can see that they were expecting 64 cents per share and 28.73 billion in revenue. And obviously for earnings per share, they had 68 cents and over 30 billion in revenue. So not only did they beat their own expectations, but also analyst expectations. And if we take a look at the market's reaction, they basically got beaten down 6% the day after. And I know a lot of people were asking, why is the market down when they basically beat on everything? And you guys know we've talked about this before. Just because a company beats on earnings or beats on revenues or beats expectations doesn't mean the market's going to react in a certain way. And part of that is it could just be traders or algorithms doing whatever they're doing, or it could be other narratives that people see about the stock. Like for instance, if we take a look at the guidance that they gave for next quarter, you can see that from a revenue perspective, it's going to be pretty good. It's another 2.5 billion or so up from where they're at this quarter. But then when you look at gross margins, they're 74.4 and 75% respectively. And if you look at those compared to what they just had, you could tell that those are lower. And we're going to get into margins here in a minute. But basically what the market is saying is that Nvidia has continued to beat expectations, but they're beating expectations at a slower clip now. Because at the end of the day, even though they're growing like crazy, their growth is slowing. And even though their margins are great, their margins are compressing a little bit. And so I think people are taking that as a sign that maybe this great Nvidia run is over. And I have a slightly different view of it. So we're going to break down some of the criticisms I hear people talk about a lot as it relates to Nvidia and see what I feel about each one. So the first one I want to talk about is this idea that all of Nvidia's revenue or revenue growth is coming from the data center segment. I've heard a couple different people talk about this, and honestly, I don't really understand what the criticism is here, unless we're saying, hey, everything and all their growth is all concentrated into one business segment. And so if that business segment goes down, then the whole company is going to go down. And okay, I guess that's true, but a lot of companies are like that. Like a lot of companies have concentrated revenues to where you could talk about like a Google where it's Google search, right? Or, ad revenue was like the bulk of their revenues. Meta ad revenue is like 98% of their revenues. So, with Nvidia, even though they do other things, the fact that the data center growth is where all their growth is coming from is because they're in the part of the cycle where the AI build out is happening and that's where all the money's going, right? So I don't know that I look at that specifically as a bad thing. And actually, when you look at their charts, you can see that obviously data center is just on this insane run where it's growing 150% year over year here in this most recent quarter. And before that, it was over 400%, which is just astronomical, ridiculous growth. Now, if you look at gaming, it's much smaller, right? 2.8 billion compared to 26 billion, but it still grew over 15% year over year. That's still pretty good growth. And then if you come down here to some of their other segments, you have professional visualization. Now, obviously, it's 454 million. That's tiny compared to everything else. And automotive, again, is 346 million, which is tiny compared to everything else. But the growth rates are, it's 19% and 36%. So, even though I understand the idea that, look, this whole Nvidia story is riding on the data center revenue. Yeah, just like any high growth company that has a really high growth part of their business or part of their revenue, that's obviously going to drive the growth for the whole company. And I don't know that we should be penalizing Nvidia to say, hey, your automotive group isn't as high as your data center. Well, yeah, because that part is not where the revenue's happening right now, right? So I don't see that as a huge deal. I think it's kind of a weird criticism to bring up. Now, criticizing the level of growth for data center and if it can continue, I think that's totally valid. But the fact that all the growth is coming here and all the revenue is coming here, to me, it's not a problem. That's where the industry trends are going. That's what's been driving this whole Nvidia boom. So to me, that's relatively normal. All right, so for the next one, Jensen Huang just keeps selling his shares, and people are taking this as some huge negative signal that here's the founder, this very experienced, knowledgeable CEO who is now at this point in the life cycle dumping all of his Nvidia shares, right? And anytime I see these type of things, my first question is, okay, but let's get to the actual details of what's going on. Now, if we take a look at what Jensen has actually sold, there's this little list here, which I think really helps. And even though these are blurred out, we know that these are all Nvidia shares that he's selling. So actually, let's take a look at 2023 first so that we get a full picture. So as you can see, he sold 7 times in 2023. These were all about 300,000. That was about 600,000. So you're looking at about 2.4 million shares that he sold back in 2023. But now let's go into 2024. So now if we go to 2024, you can see that he has actually 20 different sales of shares over the past couple months or so. And each one of those was for 240,000 shares. So 240,000 times 20 is 4.8 million shares. That's basic math that I can do. So if you add that to the 2.4 million he sold last year, he sold about 7.2 million shares of Nvidia over the past calendar year or so. And now, first of all, I just wanted to point out that all of these were part of a pre-existing plan, this, Rule 10b-5-1 or whatever, where it basically allows executives to be able to sell shares on a predetermined plan. So it's not a surprise to the market. So all the sales that he's done in 2023 and 2024 were from a predetermined plan. It wasn't like a surprise sale because he's like, oh, the bull run's over, I'm going to sell shares. It was already predetermined. It was already planned that he was going to do it. But I get it. You see this and you're like, but if the CEO just dumped 7.2 million shares of this stock, then he must know that the jig is up. Well, Jensen actually still has 862 million shares of Nvidia that he holds. So even though 7.2 million sounds like a lot, it is less than 1% of his actual stake in Nvidia. So the way that I look at this is, look, if you sold 1% of a holding, would you think that you're not bullish on that holding anymore? No, of course not. You kept 99% of your holding. So clearly you think it's still good. Now, the other part of this is, look, he's 61 years old. He's worked at Nvidia for over 2 decades now. Him being able to sell some shares, lock in some profits, put some money away, do whatever with his family, he's totally earned that. So I don't think him selling less than 1% of his stake in Nvidia is really anything to worry about or market making news at all. Now, what about the concern that margins are starting to decrease, and that's going to signal the end for Nvidia? Now, I do think that margins are an interesting thing, and that's something we should definitely keep a watch on, because if you just take a look at the history, I can understand why people are concerned. If you look at last quarter, you can see that it was 78.4%, which is one of the highest I think that they ever had. And the quarter before that was 76, and the year before that was 64%. So that's a nice little trend there to say, look, a year ago we were, way under what we are now. Last quarter we were under what we are now, and that margin is continuing to expand. But then if you take a look what they just reported this week, you can see that the margins was 75.1% compared to last quarter's 78.4%. 4%. So even though it's still quite a bit above what it was a year ago, we're getting compressing margins on a quarter-over-quarter basis. Now, is that a cause for concern? I don't know. I think it's one of those things where we need to watch it. Now, if we look at what they've actually guided for the next quarter, they've guided it to be even lower than it is this quarter. And that's why some people are saying, hey, look, margins are compressing, and this is the beginning of the downtrend for Nvidia because, last quarter was basically the peak of their margins. Now, there's a couple ways to look at this. First of all, if you look at their margin history over a longer time period, they have really increased their margins by a lot, especially over the past year or so. And so that's a double-edged sword, right? On one hand, it's really great for their business. That's part of why the stock has gone up so much over the past year or two. But it also means that the expectations are higher and their comps are going to be higher every quarter now because they've been doing so well. But I think the real question is whether or not this downtrend in margins is going to be something that continues on or kind of stabilizes itself at a certain point. And I think that's really what people are wanting to know. Like, if Nvidia's margins are going to stay like above 70, around 75, I think people would say that's really strong if that's sustainable over the long term. But if this is the first stop to 74, that's going to go down to 68, that's going to go down to 65, then I think that's why people are concerned. But there is one thing that could possibly explain what's going on. Because a few months back, there was an article about how Taiwan Semiconductor was pondering boosting AI chip production prices for Nvidia. And the comment from Jensen Huang at the time was, he totally agreed. He said, TMC's wafer price is indeed too low. I think their service price is too low, and their contribution to the world and the tech industry is underrepresented by its financial results. So what you had there was Taiwan Semiconductor, who is a huge, important, critical partner for Nvidia, basically saying we think we might raise prices, and Jensen Huang saying, you know what, you should raise prices because what you do is amazing and we need to be paying you more. He literally said that in print or in an interview. Now, it does say here that Nvidia did not confirm the timing or amount of a wafer price increase. But then if we look at Taiwan Semiconductor's most recent quarter, you can see they had a big revenue jump from the previous year, which was over a 30% jump in revenue. So is that Nvidia already paying them more, or is that something that may happen still in the future? I don't really know, but the reason I bring it up is because if Nvidia's gross margins are going down because they're paying TSM more, to me, that's actually a net positive for Nvidia because even though they'll lose a little bit in margins, we know that the capacity is limited with Taiwan Semiconductor, and Nvidia keeping that relationship super strong is something that's going to benefit them over the long term. Now, obviously, that's a lot of speculation on my part. I don't know if this margin outlook actually includes anything related to TSM and higher prices. I'm just speculating that if that really is the reason, then that would be one where it's actually a positive for them long term as opposed to, oh no, the margins are compressing. So I think a lot of times people see these big numbers here with Nvidia and they see all the comments online, and I know people get crazy about it and talk about it in a way that annoys, people or certain kind of investors. But at the end of the day, right, if Nvidia only grew at like 20% a year for the next X number of years, to me, it would still be a smashing success with what it's already done. So I wasn't looking for 4X, 5X, and have it double and double again. I was simply saying, what is the likelihood that this company is going to have market-beating returns for a period of time? And to me, it was 100%, or as close to 100% as you can get, 99.9%. And that's why I did what I did. It was very simple. And I just think it's been such a crazy ride, and there's so many strong opinions on both sides of it that, yeah, I get it. If you didn't buy Nvidia by now, it'd be a little scary getting in. But, I looked at it back in March when everyone thought I was crazy to buy then, and it made perfect sense to me then. And when I look at it now and what they just reported, yeah, there is some deceleration of growth. There is some compression of margins, but when I look at it in totality, I look at their growth rates that they're still guiding for next quarter and kind of beyond. To me, it's still a good place to keep my money. So I'm holding on to Nvidia. I think they're going to continue to do well. How well, we'll just have to wait and see. All right, so next up is Lululemon, and here's what I said I was looking for from them in their earnings call. All right, Lulu is even further away since they just reported earnings not too long ago, but the stock overall has been getting hammered. So I want to see if their growth rate continues to be strong as it has been, specifically outpacing their competitors, and if growth in North America starts to pick up again. All right, and last quarter, this is the outlook and guidance that Lululemon gave us. They said they expect revenue to be between $2.4 billion and $2.42 billion, which would represent a growth of 9 to 10%. And then they expect diluted earnings per share to be in the range of 2.92 to 2.97 for the quarter. And if we take a look at what they just announced, and they literally just did this a few minutes ago, they announced revenues of $2.4 billion, which was an increase of 7%. And I'll have to go back and do that math because I thought they just said $2.4 billion would be 9%, but now they're saying it's 7%. So I don't know what the right number is there. And if we look at earnings per share, we see that diluted earnings per share is $3.15, which is well above kind of their earnings per share guidance. So at first glance, the revenue came in at the bottom end of their original guidance, and earnings per share came in quite a bit higher than their original guidance. And I'll bet you anything that the reason why that is because they executed a bunch of buybacks, which they authorized last quarter. So if you guys remember, one of the things that they announced last quarter is $1 billion increase in their stock repurchase program. And I believe they had like $1.7 billion remaining from last quarter. And I'll bet you anything that they did a bunch of buybacks this quarter as the stock price was really low and they were struggling probably with some revenue and growth issues. So if we come back to this quarter, let's take a look at what they said here. So net revenue increased 7% to $2.4 billion. America's net revenue increased 1%. International increased 29%. Then if we take a look at their margins, so margins increased 0.8. Operating margin increased 1.1%. So that's not too bad. And here we go. The company repurchased 1.9 million of its shares for a cost of a little under $600 million. So, out of that 1.7 billion, they executed close to 600 million of it in this past quarter, which, arguably was a pretty smart use of capital because Lululemon has been down over this past quarter quite a bit. So they were actually able to make pretty good progress there in terms of positive impact for shareholders because the price, I think, was value accretive at this point. And if we look at the outlook they're giving us for the third quarter, they expect revenue to be 2.34, 2.365, representing a 6 to 7% growth rate. And then earnings per share to be 2.68 to 2.73. And I would have to see what that growth rate is for earnings per share. And then if we just take a quick look at what the market is doing, it was down about 5% when I originally looked, but now it's up 2% in the aftermarket. I'm not sure if the earnings call is going on right now or not. So I'll have to keep watching that. After hours and during the earnings call, it goes up and down like crazy. It doesn't necessarily mean anything, important. We'll just have to see what the market does, especially tomorrow. But as of right now, it's up 2%. After hours. So here are my general thoughts on what Lulu reported. In terms of the numbers, I don't really have a strong opinion either way. It's a little bit disappointing because clearly the slowing of growth story that's happened over the past couple quarters is continuing, right? So the revenue growth is down a little bit. It's, under double digits. America's revenue growth is still positive at 1%, but I think last quarter was like 3%. And the international is 29%. I think last quarter it was over 30%. So again, you kind of have the same story. Growth is slowing. So now the question is, all right, well, is this something that we can turn around? Now, what I will want to know in the actual transcript of the earnings call is how much impact did the breeze through leggings thing have on that number, right? If it was a big impact, then, maybe this isn't as bad as it looks because you say, okay, well, yes, growth is slowing, but we also had a product issue. So once we figure that out, we fix that, then this should improve. If that's the story, that's not terrible. But if it's more like, breeze through leggings really had no impact, and that's going to be an impact for the future. And that's why our guidance for revenue is down from, previous quarters. Then that's not great, right? I mean, at the end of the day, what you want to know from Lululemon, or at least what I want to know is, is this a story that's going to turn around in terms of growth? Now, even if the Americas growth is never going to be as crazy as it was before, as long as it gets to a steady state, I think that's okay because international is really the big opportunity for them, along with men's, I would say. But at this point, it's really hard to tell without additional context as to what's going on because it's kind of this still slowing growth story that's just kind of chugging along. And the other part here that was a little concerning is they actually guided their full year revenue and earnings per share guidance down. And this is the first time I think in the last 10 quarters or so that this has happened. Now, I don't know if I told you guys, but I've been tracking obviously Lululemon, but other companies, kind of the management guidance compared to their actual results. And what I see from Lululemon is they are pretty consistent at beating their guidance and raising their full year guidance almost every quarter. And so not only are they not raising their guidance this quarter, but they're actually downgrading it. And so that to me is a little bit worrisome for them. And that actually, as of right now, without actually hearing what's going on in the call, this to me would be the most worrying part of it, because what that tells me is, look, they just guided up last quarter, right? Even with the tough quarter that they had. And if the reason they're guiding down, again, if it's breeze-through leggings and it was a one-time issue, then maybe that's okay. But if it's not related to a one-time thing and it's more of just a general normal operations, this is what it's going to look like going forward, then this is a little bit scary. Because the whole point of why I track those things is because I want to understand the reliability of the management team whenever they give us guidance. And so with Lululemon, it's like, look, they've been rock solid for 10 straight quarters and now all of a sudden they're guiding down, right? If it's something unexpected, fine. If it's bigger than that, then it's something to consider. So in terms of how I'm feeling about Lululemon overall, now it's my only negative holding right now, right? All my other holdings are in the green except for Lulu, which is down 20%. And, that's actually, believe it or not, an improvement over the 30% it was down, I think, last portfolio update. But right now, it's not something I'm going to overreact to. I'll take a look at their earnings transcript, see kind of what they say the issues are. And I really think Lulu is trading at an attractive level right now. So even with challenging kind of growth prospects, I just think they're trading at a level that it makes sense to kind of hold on and kind of see how they do. I mean, again, this is a company that is still able to get to double-digit earnings per share growth. I mean, even in this quarter, which wasn't a great quarter, the earnings per share growth, if you include the impact of the buybacks, is, close to 18%. Or like even in their guidance, when they say, look, we expect diluted earnings per share to be in this range now, which was a guide down from the previous quarter. But it does say that this guidance does not reflect potential future repurchases of the company's shares. So again, they still have a good 1.1 billion or so of repurchases authorized. So until they get this growth stuff figured out, they can use those repurchases while the stock's trading at an attractive level and still get earnings per share growth for shareholders, which in my opinion is a good use of cash. Now, at the end of the day, they still need to get their growth stuff figured out, because if that doesn't happen, then it's not going to be an attractive opportunity no matter what. But if this is just a short-term issue and this is a way that they can kind of keep the whole boat afloat for a while and still be getting good earnings per share growth, then that's okay. Okay, so lastly, I said that I added a new stock to my portfolio, and I have. And that stock is Cloudflare. Now, I'm not going to go real deep into Cloudflare in this video because I'm going to dedicate a whole full analysis video to it next week. But I will get into the highlights of why I like it and why it was on my radar. Now, you guys know that most of my portfolio is in mega cap tech companies. And I mentioned that I'd been looking for something with a smaller market cap that was earlier in its business life cycle that would still have some room to grow. And even though Cloudflare is trading at a whopping 90 price to cash flow, I think it's a really interesting long-term growth story. And so let's talk about what it is, because that's really a great question, because a lot of my interest in Cloudflare is as much about what I think it's going to be as to what it is today. But in general, I would call it a global cloud computing platform. It started out focusing on tracking email spam and network threats, then becoming most known as a CDN or content delivery network, and then now have begun to expand into more cloud security solutions, both for networks and user access, as well as a developer platform for cloud-native applications and edge processing, especially for AI inference processing. So I know I said a lot there, but we're going to dive into all that and more next week. But if I had to boil it down to a handful of things, I would say where Cloudflare shines is they have a product that people like using. So the comments that you'll see are things like awesome features, generous limits, high value for the cost, and they made it easy to access and start using for customers of all sizes. Having a free tier does that, which makes more people familiar with their platform and the features they offer. And the fact that they're developer focused bodes well for them as an application platform in the future. And what I mean by that is Cloudflare is a platform where your developers will be like, oh, I love using this. This is great. This has a ton of great features, as opposed to others that are maybe more enterprise sales focused, where they're more attractive to maybe the IT managers or the executives. And probably most importantly, their product vision is hitting on multiple secular uptrends. Obviously, cloud computing in general is a secular trend that's still going on, but then specifically cloud security. And then, of course, edge processing or serverless applications, which lends itself to AI inference processing. And to me, those are very interesting places to be, and I think Cloudflare's history and their architecture give them a strong advantage to potentially win. Now, obviously, when you look at the valuation, you're going to cringe because they're trading at a 90 price to cash flow like we talked about before. And then if you go up to their price to earnings, you see that it's not even measured because technically they're not profitable yet. Now, some of you guys may know that I don't usually go for companies that aren't profitable yet. Like if operating income is less than zero, I usually just kind of move on and I'll wait till they become profitable before I really dig into them again. But for me, Cloudflare was an exception because if you look at how much they actually put into R&D, if you exclude that, they actually would have been profitable back in 2020. Now, obviously, I know you can't just exclude R&D, but that's money that they're investing back into the business to be able to compete in the industries that they're in, which isn't necessarily a bad thing. But it's one of those things where they're putting a lot of money into R&D, which is what's making them unprofitable. And so that's not something that I'm going to worry about too much, especially when you consider where they're at kind of in their business life cycle. Now, if we take a look at growth, you can see that they're growing at a good clip with revenue growth being over 30%. They've actually been growing even higher than that in previous years. And if you look at operational cash flow growth, it's also a little bit higher as well. And now this is a company that has a lot of stock-based compensation in relation to their cash from operations. And again, normally that's something that I would definitely grade them down for, and I have. But again, because of where they're at in their business life cycle and being that they're a tech company, these are the type of things that are going to be there. And it's just something that I'm going to monitor and not necessarily disqualify them if I'm interested in the business. And you can kind of see that in terms of how I'm grading them, with the business being good, operational performance being okay, and valuation being poor. And the last time I bought a company that looked like that was actually Starbucks, and that didn't turn out so well for me. But I really do think that Cloudflare is a different animal, and I think their business prospects are so good that I'm willing to kind of ride out the ups and downs of being a younger tech company just to see how they do. Because at the end of the day, I think it's about secular growth in critical parts of tech, and I think it's an interesting balance to the rest of my portfolio that is very heavy with well-known monopolistic companies like Amazon, Meta, and Google. But in terms of Cloudflare and adding into my portfolio, I added 124 shares of it yesterday at $81.79 a share, which you'll see in my portfolio update on Monday. So definitely a sizable initial buy, even if it is just over 3% of my portfolio, which is the lowest out of all my companies. But you'll hear a lot more about Cloudflare next week, and I can't wait to hear all your wonderful comments about me buying a 90 price to cash flow stock. So flame away. Now, if you want to know my thoughts about the Fed potentially cutting rates and what it means for our stock portfolios, click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.